In this video, let's talk about two ASX growth stocks that I think are absolute dark horses in 2021. If you don't have enough time to finish watching this video, the two stocks are Nitro and Kodan. You can always come back to this video later to hear why I think these are dark horse growth stocks for 2021. But before we start, let me get the boring stuff out of the way. This video is not financial advice or recommendation to do anything. It's just general information for entertainment purposes only. Without further ado, let's go! Here are the three main things I look for in a high quality growth stock. One, I expect that the earnings are improving or growing on a year-on-year basis. Now, because this is a growth stock, you want the earnings to be improving or growing by more than 10%. Number two, I would like to see strengthening balance sheet to withstand any external shocks. And number three, I would really like to see beginning glimpses of their economic moat. Of course, it's also really important to look at their cash flow as well, because those numbers are a lot harder to cheat than their earnings. But for the purpose of this video, I have left out the cash flow part and also the valuation part, just so that you can do your own research. The first stock that I think is an absolute dark horse is Nitro. As I'm recording this video, they're trading at $2.83 with a 538 million market capitalization. They are a document productivity software company focusing on the most critical documents in the enterprise. Many of you might remember Nitro being the first Adobe Acrobat alternative back in the days. And since then, they have transformed themselves into an enterprise software company. So let's dig into their numbers and see what's under the hood. Over the last 5 years, Nitro have improved their earnings by 28.8%. They are not making a profit yet, but are getting really close. This is a growth company, so I don't expect them to chase after profitability so soon. It's more likely that they invest in their people, their marketing, and product to ride out the document digitization tailwind and then optimize their P&L to go after profitability. And on that point, their gross margin is between 89 to 90%. So as they grow their revenues, they will have plenty of resources to make a splash in marketing and engineering. Before we take a look at their balance sheet, let's take a look at their key SaaS metrics. Now, some companies tend to make this really difficult by scattering metrics everywhere, but thank goodness that is not the case for Nitro. The first key metric that I'm the most interested in is net revenue retention. And that tells you the growth of recurring revenue from existing customers net of churn. 118% net revenue retention means that Nitro's existing customers from the previous year are spending more this year after taking into account people leaving Nitro and also plan upgrades and downgrades. That is a hallmark for a great enterprise software company in the making. Generally speaking, when we're looking at LTV to CAC, if that number is above 3, it's indicating that the business model is working. However, if that number is above 5, it could mean that the business is underinvesting in marketing. As of recording this video, their balance sheet looks damn strong. There are more than enough current assets to cover both the current liabilities and the long-term liabilities. And out of this 51 million current assets, 43 million of that is straight cash. Given that central banks are waving their money printers in the air like they just don't care, I really wonder how is Nitro going to manage their cash position. But nonetheless, the point I'm trying to make here is that with such a strong balance sheet, I don't think they'll have any problems withstanding any external shocks. And if the opportunity is right, they could even go out to acquire companies to help them grow even faster. And on top of all of that, they have no debt, so I can't really complain about anything. Let's talk about their moat in the making. First, Nitro is a founder-led company. The founder have stuck with this company for 15 years, took it public, and are still going at it. That's not a mercenary behavior. That's an evangelistic behavior. More importantly, I think the ability to headhunt talent, especially key executives, are so underappreciated. In Q3 2020, Nitro was able to convince ex-Bluevine, ex-Google growth investing arm to join Nitro as a CFO. That's not all. In the same quarter, they were able to convince ex-Intuit, LogMeIn, and Citrix to come in as their CMO. Not to mention, they brought back their previous director of product as their chief product officer. If the ability for an ASX tech company to headhunt talent like this is not gangster, I don't know what is. On top of that, the net dollar revenue retention rate at 118% is demonstrating that there is a level of product market fit amongst their enterprise customers. Together with an out of this world gross margin, I really think Nitro will have a really good chance to become our next tech unicorn. From an industry prospect standpoint, I think the pandemic have shined a light on the importance of digitization, and a lot of companies was forced to go from 0 to 1 on digitizing their paper-based workflows. The PDF productivity and e-signing market alone is about $5.5 billion US. And once the first era is complete, according to the founder CEO of Nitro, we are going to move towards more intelligent workflows, minimizing human input error. If you're really keen to learn more about intelligent workflows, highly recommend you to read more about how the legal industry is using natural language processing and machine learning to analyze documents. It's super fascinating. The next ASX growth stock that I think is an absolute dark horse is Kodan. As of recording this video, it's trading at $10.59 with a $1.91 billion worth of market capitalization. Fun fact, Kodan was founded in 1959, so this company is a bit more than 60 years old, and they are on my growth stock watch list. Kodan is predominantly a communications and metal detection hardware company. Metal detection, as in you walk around with one of these, and it'll start beeping if you're close to gold or other metals. And communication, as in tactical long-range or short-range communication devices for military, public safety, or just general land management. Yes, I know that this is probably not one of the more exciting things to talk about, and I do love my e-commerce and tech companies, but I pinky promise that the numbers are not boring. Over the last 5 years, this company grew its earnings by more than 26%, and this is a 60-year-old company. They are currently profitable with a 34% return on capital employed and an incredibly strong growth in free cash flow. These are really high quality cash flows generated by strong return on capital employed. But wait, there is more. If we take a look at their balance sheet, they have more than enough current assets to cover both short-term liabilities and long-term liabilities, which means that they shouldn't have any issues dealing with external shock. And by the way, 92 million out of this 157 million short-term assets are straight cash, which means if they really want to, they can take advantage of the current situation, go out and hunt for acquisitions to grow faster. And Kodan has no debt. Given the low interest environment, they also have the opportunity to leverage a little bit to grow, if it makes sense. When it comes to Kodan's moat, the numbers speak for itself, with a 25% return on equity and the 34% return on capital employed, and doing all of that with no debt. And I know I said to leave cash flow for you to research, but Kodan's free cash flow is 23% of their revenue. These are all signs of a business that's incredibly fine-tuned, but at what price? And would they be able to continue to grow at this pace? Now, according to RogerMontgomery.com, #NotSponsored, the conversation with the Kodan management team have indicated that a lot of people are taking up metal detection as a hobby, since you're basically alone in the wild anyway, so you're not impacted by social distancing rules. On top of that, the demand for gold metal detectors continue to be strong out of Africa. And the communication division saw a strong demand after Kodan signed a deal with the Afghanistan government, not to mention the US stimulus have accelerated few of their purchasing decisions from US government as well. Now, I'll be keeping a very close eye on these dark horse ASX growth stocks. But what do you think? What do you think are some of the key risks that will prevent them to blossom into a better company in 2021? So thank you so much for watching this video all the way to the end. I usually document my findings in Discord first before I make it into a video. So if you want to be notified of that and wouldn't mind be part of my fortnightly Q&A, consider supporting this channel via Patreon. Nonetheless, if you have learned something new, remember to gently smash that like button, subscribe to my channel and click onto the bell so that when I release future videos, you'll be the first one to know. Until next time, my name is David. Otto will always do the honors and see you very, very soon.